As of yesterday, the price of gold was at 2,224.78. So in these 56 years or so, the average gain per annum in the price of gold has been 9.4%. And if you look at the Bank of England inflation calculator, according to them, since 1968 till 2023, Bank of England inflation calculator says that CPI averaged 5% per annum. So you've gotten more than enough protection from gold, from this debasement of the currency. And I would argue that this 5% is probably a lot higher. Maybe it's more like 6 or 7.
As of yesterday, gold was priced at $2,224.78, reflecting an average annual gain of 9.94% over the past 56 years. According to the Bank of England's inflation calculator, the average yearly CPI during this period was 5%. This indicates that gold has more than preserved its value against currency debasement. However, it's likely that actual inflation was higher, potentially around 6 to 7%, further emphasizing gold's effectiveness as a hedge against inflation. Mario Innecco, also known as Innecco64, is a well-known financial commentator and YouTube content creator who explains how the Bank of England's handling of inflation targets and CPI adjustments has raised questions about its credibility. From 1997 to 2020, inflation averaged 2.7%, exceeding the 2% target set when the bank gained independence. However, a recalculation in 2021 conveniently lowered the average to 1.9%, just below the target, suggesting potential manipulation to enhance the bank's perceived competence. Mario says this change coincided with political pressures, including Liz Truss's administration, which was poised to scrutinize the bank. Furthermore, the government altered the calculation for inflation-linked bonds, UK linkers, shifting from the higher RPI to the lower CPI starting in 2030. This decision, which some view as a default, triggered a sell-off in the gilt market and significant losses for pension funds. These actions highlight the challenges of relying on official inflation metrics when investing in government bonds. Investors typically assess returns against inflation to gauge compensation for lending to the government. If inflation measures like CPI are manipulated or unreliable, it becomes difficult to determine whether bond yields adequately offset currency debasement. This raises broader concerns about the trustworthiness of government financial instruments and the actual rate of inflation impacting long-term investments. Let's dive into the video for more insights. If you enjoy the content, don't forget to give us a thumbs up and subscribe to our channel for the latest updates.
If you could prove that the Bank of England had not kept its target of 2% CPI, right? And I think that's why they changed the CPI, the ONS, the government and the Bank of England. They were all involved. We're told that the ONS is independent, that the government and the Bank of England are like separate. But I'm sure they did something there, because in the same video that I did in 2021, the 25th of June 2021, I spoke about the Bank of England that from the period of 1997 to 2020, in 1997 was when it gained independence, and it had to keep a 2% CPI target. Inflation had averaged 2.7%. Did the same exercise. A pound in 1997, cost in 2020, £1.86. And then in my video, on the 20th of July, when I exposed this change, I looked at that as well. And the pound in 1997 cost in 2020 £1.55, not £1.86. So guess where that average dropped to? Well, conveniently dropped to 1.9%, which is just below the Bank of England's target of 2%. So, and that's why I think they did it. That's why they changed the CPI, to make the Bank of England look more competent, because you had Liz Truss coming in. Liz Truss was going to put a spotlight on the Bank of England, and then, of course, they got rid of her through the manipulation of the markets, in my opinion. Some people think it was the budget, but if you look at the gilt yields, they started going up way before she came into power. And a lot of people don't. Well, I haven't seen anyone talk about the fact that the High Court of England, the highest court of the land, decided against big corporate pension funds to, in their case, against the government, because the government changed the way they calculate the coupon for UK linkers, which are inflation protected bonds. Instead of using RPI, which is always a higher number than CPI, they're going to start using CPI from 2030. So in my book, that was like a default. And that's when the gilt market started dropping and yields started spiking, and a lot of defined benefit pension programs started getting hammered. So why am I going through this inflation CPI fudge? Well, because when you're buying government bonds, and this is what this video is about, should you really be buying gilts or treasuries? When you buy government bonds, you want to know what the rate of currency debasement or inflation or is really. And what investors use nowadays is not money supply, but they use the CPI or other measures, PCE. And if you can't really trust those measures, how can you tell whether the compensation you're receiving from the government for lending to them is really good compensation?
Mario highlights gold has historically served as a stable store of value, maintaining purchasing power over centuries. From 1968 to 2023, gold's price in pounds rose from £14.61 to £2,224.78, averaging a 99.4% annual gain. This far outpaces the Bank of England's reported average inflation of 5% per year during the same period, highlighting gold's effectiveness in preserving wealth amid currency debasement. However, some argue that actual inflation may be understated, possibly closer to 6 to 7% given the adjustments to CPI metrics in recent years. Mario, on his live streaming, says that the UK and US face mounting fiscal challenges, with excessive deficit spending driving concerns about economic sustainability. Billionaire investor Ray Dalio recently warned of a UK debt death spiral, echoing long-standing warnings about unsustainable borrowing and government dependency for growth. Both nations must reduce deficits to around 3% of GDP to stabilize finances, but doing so risks stifling economic growth, given their reliance on government spending. This creates a tricky balancing act, leaving policymakers constrained and markets wary of potential fiscal crises. Now, let's get back to the interview.
Because gold is money. It's the ultimate store of value. It's the most stable store of value. It has for over thousands of years maintained its purchasing power. And I've looked from 1968, where we get data from the LBMA for the pound. And this is what's happened with the price of gold. In 1968, the price of gold was £14.61. And as of yesterday, the price of gold was at $2,224.78. So in these, 56 years or so, the average gain per annum in the price of gold has been 9.4%. And if you look at the Bank of England inflation calculator, according to them, since 1968 till 2023, Bank of England inflation calculator says that CPI averaged 5% per annum. So you've gotten more than enough protection from gold, from this debasement of the currency. And I would argue that this 5% is probably a lot higher. Maybe it's more like 6 or 7. They fudged things back in 2022, so you can't really trust the numbers. And gilts, well, back to gilts. And Ray Dalio came out yesterday, of course, said Bridgewater founder Ray Dalio warns of UK death spiral, sell-off in gilt since budget suggests market balking at higher borrowing needs, says billionaire investor. Well, and of course, many of you know that I've been warning about the UK debt time bomb. I've got a playlist for it. I've been warning of this for years, only because it's maths, right? And because I've known that the political class, not just here in the UK, but in the US, they're all Keynesians, and they're going to keep spending and inflating. And especially here, they're going to keep the size of government bigger. There's very little political will to do the right thing, because we've gotten to a point that to do the right thing, you have to implode the whole system. And I've also warned, of course, of UK economic collapse 2021 and beyond. So it looks like the mainstream and one of the world's biggest hedge funds are joining me. So what is Ray Dalio saying? Well, he's basically saying the same thing. Both countries are doing big time deficit spending. The U.S. even more than the UK. The U.S. Is deficit spending more than 6% of GDP, which is unheard of in a time where you supposedly don't have a recession. So this number is probably even bigger. The UK is still at 4.5%. And Ray Dalio says that to get things under control, they need to reduce it to 3% of GDP, not even go back to a balanced budget. Well, that's something impossible, I would say now. So that's what he's saying. And he's saying what I've been saying, that they're between a rock and a hard place. Because if they try to rein in the government spending and deficit spending and the size of government, they're also going to hurt growth, because they've been depending on government for growth to keep that GDP number embellished.
Gold's consistent performance as a hedge against inflation underscores its value as a safeguard in uncertain economic times. Meanwhile, the fiscal challenges faced by the UK and the US highlight the precarious balance between managing deficits and sustaining growth, raising questions about the long-term stability of government finances and the reliability of inflation metrics. How might changes to inflation-linked bond calculations impact investor confidence in government financial instruments? What strategies could policymakers adopt to reduce deficits without significantly harming economic growth? We'd love to hear your thoughts in the comments. If you found this video helpful, give it a thumbs up and subscribe for more updates. Thanks for joining us on this journey.